Good to see you again, Jack. Do you agree with Lee?
I have to agree with Lee. Lee is such a great investor, and actually he's a friend of mine. You know what? I've looked at a lot of the bear markets related to recessions. And in many respects, he's right. Although I will say I point to really two, the 2000s and then the 2008. And both, I would argue, and that's, I think, what he's looking at. I would say both, I would argue, was more than a recession. It was really a systemic problem. Obviously, we know what happened with the great financial crisis and the banking system and Lehman and all that. But even in 2000, if you remember, yes, the Fed started raising. They were behind the curve because Greenspan didn't know if we were going to be able to turn the lights on after Y2K. He kept rates artificially low. Remember, he was flapping his arms in 1996 with irrational exuberance, and he didn't raise rates until 2000. Same sort of thing, started to raise rates. We saw the tech crash. But then what happened was, remember, in 2001, we had 9/11. And then we had WorldCom and Enron. And I think those two pieces together caused investors to really wonder how real and how sustainable the equity market was. So I don't think we're in that kind of position. I don't think we're in a 2008 position. And that's really where Lee is drawing his 40% downdraft conclusions. If you look at all of the downdrafts related to recessions, we're pretty much right in the middle of it right now. We're kind of median level. And even the 1980 with Volcker, market was down 16.5%. So I think we're pretty well into where we need to be.
So if we are, and we're down about, what is it, 23, 24% in the S&P from the recent high back in early January, if we're at the middle point, that puts us at 40% off the high, right? It puts us at 40 or even more. So would you be surprised, I guess is what I'm asking, if we go down another 20 percentage points from here?
I would. I'm looking at the S&P, peaking in January. So I'm looking at, pretty much like you said, 2%, somewhere in there. But it's really, it's funny. We put a model together that just looks at changes in interest rates, changes in earnings growth expectations, and we're right on target. We started the year at 1.5. We're now at around nearly 3.5. We have a 9% earnings growth expectation, and our model suggests the S&P should be off about 25%. So we're very close to what the textbooks would say. I guess, that's good news perhaps because things are behaving themselves. But maybe we need to go farther, to just kind of wash out, if you will.
Yeah.
Because there really hasn't been much selling. That's the interesting part of what I'm seeing going on right now.